types of risk also. Okay. Next, types of investors will start. What are the various kinds of investors will be available? So, if you categorize the investors, we can categorize the investor based upon this categorization. That is individual, institutions, mutual funds, pension funds, endowments funds, insurance companies, and banks. So here we can classify the investors, means not an individual only we are going to classify it. We can classify the artificial person also as a type of the investors. Artificial persons are nothing but your financial institution, financial services, and financial instruments. We can call those as the investors also. So first we will come to one, that is individuals. Individuals are the persons who will be investing their investments either to the direct market investments or through the mediator, intermediary, although that is with the help of the portfolio manager, they can invest. So whenever they will be don't invest directly, they can invest directly, and the entire risk will be there on the heads of the investors itself only. So most probably, in India, most probably individuals who belongs to the age category of 22, they will be starting at that time. They'll start investing their investment. Okay. So next, institutions is nothing but a financial market. So here as a they will be considering as a representative for this thing. So here institutions will place an important role here, apart from what is it, it will considering as a middle person in between the institutions, in between the investors as well as a company. So they are going to be act as a middleman in between the investors and the company. So they will be investing on behalf of the investors or the individuals, and entire risk and the decision makings and for portfolio decision making, how to invest, where to invest, all those things will be taken care by these institutions. Next one, mutual funds. Mutual funds is also one kind of investments. Here any persons can join into a mutual fund. So here we can have two sorts of investment, that is two sorts of mutual fund. That is the first one is a direct mutual fund. So with the help of the directly with the market, we can purchase the mutual funds. With the help of indirect, that is with the help of fund managers, we can move on to the mutual funds. And the pension funds, these are the funds we can having your, nowadays you are having a private pension funds also. Most probably these pension funds will be either will be given by the, most probably will be government securities, and nowadays you can have this kind of facility with the help of PPP, that is public provident funds. We can have our own funds. Endowments funds, generally we consider this endowments funds from the non-profit organizations which is going to manage the funds which generate study, and study returns will be there. Why? Because it is such funds will be managed by the charitable organizations. Most probably such type of organizations will be, so that's why we'll be having a constant and study reasons. And insurance nowadays, after the COVID, insurance has been considering as a topmost priority for investment opportunity. So we consider investment nowadays as an investment also insurance. So both for the life and non-life holdings, for the long term term, for the term insurance policies, for the health insurance policies, nowadays it's becoming a very famous after the COVID effect. Banks, so banks is also one kind of intermediaries acting as a financial instruments and financial services, which will be helping to employ to investors to come forward to invest, as well as government. Generally, most probably government securities will be including whenever government securities, that is treasury bonds, we can consider as a risk-free rate of return also we can call. So most probably it is entirely depend upon the whatever the orders and whatever the decisions has been taken by the RBI, that may be in the form of your cash reserve ratio, or that may be in the form of your statutory liquidity ratios. These are the certain um, types of the investors. Come to the differences between the investment and the speculation. So investment means here if we are having a pre-planned things, investors always think in advance. He will be taking a decision step by steps and systematic manner. He will be holding the funds, and systematically he will be investing the funds, he will be raising the funds, he will be utilizing the funds. All those things will be done in a systematic way. They will be concentrating on the future also, and decisions also they are going to take based upon the moderate risk, high risk, or whatever may be the things. And they will be considering the market fluctuations also. Without having any proper planning, the investors are not going to do any kind of investment decisions. Whereas the speculations, he's also been planning, but the whatever the risk will be taken by the investors and the speculators is very high. Means on the spot, whatever the fluctuations will be there in the market. So based upon that small fluctuation, the speculator is going to take the chance. He's going to grab that market. So that is the main difference will be there in the investment and the speculation. fraction. So fraction of second gap will be there. Most probably it will be there. The speculators we will find most probably in the field of options, because they will be having more grip on the market. So how the within a fraction of seconds how the market will be changing. So they will be grabbing that fraction of second, high risk and high return. So if you are they have been investing with the speculator, high risk will be there. Certain simultaneously high return will also be there for the speculator. Gambling, yesterday I have explained to you people. So securities, functions of securities also I have told. Types of things completed. Next, SEBI. SEBI. So SEBI is a Security and Exchange Board of India, which was earlier established and administered by the board in the year 1998 April, which has been given a statutory status under the section of 3 of Securities and Exchange Board Act of 1992 on 30th January of 1992. So here the controller of capital issue, we can call as CCI, was abolished with the view to have a SEBI as a single agency to look after over a capital market under the SEBI Act. So here SEBI, which was been founded on in 1992 under the SEBI Act of 1992. The headquarters of the SEBI has been located in Mumbai, and the regional offices will be there in Delhi, Chennai, Kolkata, and Ahmedabad. This is the structure of your SEBI. So the main intention behind this SEBI is to ensure that the Indian capital markets is going to work. Indian capital market has to work in a systematic manner, and it should provide the investors with a transparency environment for their investments. Whatever the investments want to provide, if I want to invest in the security A, so full transparent information has to be provided by the companies. I want to know full and clear information about the investment opportunity, whatever the investment has been provided by the particular company. So that transparency has been done with the help of the SEBI itself only. So all the financial institutions which were with it, they are going to provide the transparency information to the investor for their investment. And it is also one of the reasons for setting up SEBI to prevent the malpractices, whatever may be the malpractices which is there in capital market, and promote the development of the capital market. So SEBI will be having certain type of powers where it will going to regulate the business of the stock market and other security markets and mutual funds also. So whatever may be the regulations and registrations of market intermediaries are regular body, they are also carried out by the SEBI. It has the responsibilities to prohibit and regulate the business fraudulence, trading, unfair trade practices, and misorder of dealings with the of a stock market. So here, whatever the takeovers has been mentioned by the SEBI, the stock market has to submit the periodical and annual returns for the SEBI, and it is having a multi-pronged duty to promote the healthy and growth of the particular financial intermediaries. So the structure, if you look at the structure of SEBI, if you look at the structure of SEBI, we are having different types of departments which have been under headed by the SEBI. First, foreign portfolio investment and custodians, human resource department, information technology, investment management department, office of the international affairs, commodity and derivatives market regulations, national institutions of security markets. Apart from these departments heads, the senior management of SEBI is also going to consist of certain board of members which have been appointed by the following. First, the chairpersons which has been nominated by the Union Government of India, two members from the Union Finance Minister of India, one member from the Reserve Bank, and five members nominated by the Union Government of India. So, who are the board of SEBI means the chairperson, two members from among the officials of the central governments, one member from the Reserve Bank, and five other members to whom at least three shall be whole time members, and they have been appointed by the central government. So, the chairperson of SEBI is appointed by the central government. So whatever the governing body which will be there for this SEBI is all the things we have been learned in the previous, that is the members of the stock exchange which is going to elect six members for the stock exchange, and the central government is going to nominate not more than three members, and the board nominates three public representative, and the SEBI is nominated a person who is not going to exceed the three. So these are the governing body of the SEBI which is going to include the structure. Apart from these, board of directors, board of SEBI, and governing board of the SEBI. This is the particular structure of your SEBI, and we'll move on to the what are the various functions and objectives of the SEBI. So first objective, always it going to protect the investors' interest in securities and to promote the development of the security market, regulations of the securities markets, and the whatever the matters which have been concerned therein by and incidental thereafter. So in keeping all these statutory abbreviations objectives, the SEBI has to set up itself a strategic aim for each of the four key space. So apart from this objective, it is also going to be give a strive provide a transparency and efficient market where enable to raise the resources, and who are the intermediates will be available in the market. It is going to render a market in which they are going to have a complete and freely operate in a manner which gives the investors and market participations, which gives a confidence that the market is very much efficient. So functions of SEBIs, what are the various functions will be there under the SEBI means proactive functions, development functions, and regulative functions. So under these proactive functions, we are having different types of categorizations. That is, the proactive functions are those which is mainly focusing on the functions of SEBI, which protect the interest of the investors and the security of the investments. So here, what kind of a functions they will be performing under this proactive functions means it is going to check the price rigging or any kind of a profits inside the trading, any trading in trading the gray market or black market are there. All those things has been performed by the SEBI, and it also going to prohibits any kind of a fraudulence which is happening or unfair trade type of a practices is going to happening. Such kind of issue also has going to done by the SEBI. Next, developmental functions. Under developmental functions means it going to promote the training for the intermediaries of the security market and promote activities of stock exchange, which is going to adopt a flexible and adaptable approach. It permit internet trading through the register of the brokers, and whatever may be the regulatory functions, it is going to give and regulate some code of conduct to regulate the intermediaries, and it is going to brought a regulatory preview and private placement, and it will register and regulate the working of the stockbrokers also. Apart from this, it is going to perform under such an other SEBI, other functions also. SEBI regulations, you can have guidelines. Okay. Next, we are going to have a stock market indexes. So what are the stock market indices and stock market will be there? So stock market, whenever you people are been observing the stock markets, you know how the stock market is going to fluctuate. The stock market will be fluctuate within a fraction of seconds. Within a fraction of seconds, within a fraction of seconds, if you find out, look at in the stock markets, we are having two types of stock market, that is bull market and bear market. Whenever any changes in the increase in the stock market, we can call as a bull market, and whenever any kind of a fall in the market, we can call as a bear market. So the important concepts which will be including under the stock market are your open, high, low, close, volume, bid, offer. These are the certain components which will be included on the stock markets. Means at what is the starting means stock price, the beginning of the day we can call as a morning price also, that is called as a open. The stock price which reaches the highest level in that particular day, what is the highest price, and in that particular what is the lowest price, and by the end of the day how what is the price of this particular price it is going to close, that is close, and how many number of volume means quantity has been sold off for that particular stock. And bid, what is the buying price we can call as a bid price, that is called as bid, and offer price, what is the selling price has been offered in the market, that is called as offer price. And short term trading in this it is used stock market from the 1 week to a couple of month, and mid it is called 1 week or the couple of month or 6 months or 8 month we can call as. Long term means we'll going for the long term more than 1 year period of times. And jobbers, speculators, speculations, all this process, these are the important components which will be there under under your stock market. And what are the methods which will be included means full market capitalizations method will be there. Full market capitalization method is nothing but your whatever the current prices which will be there, means whatever the scripts which have been determining underweighted in this index, that number of shares which have been outstanding is going to multiplied by the market price of that particular companies. That is we call as your full market price. So free float market we can call as a market capitalization method also. In this methods we are having different types of things where we have been having a capitalizations. So under these stock markets we will be having, we are providing the dividends capitalizations models where here different shareholders is going to get a what is that dividends in returns by the equity shareholders, which is going to be provide this. Okay. Anyone of you already invest market? One, two, three, four. Very good. And I'm happy with that. Have you started? Generally, अपने को अपना जो हम call, it will actually go up, and within no time, it will actually crash like anything. So then, why depend on some? So we'll understand, and with the help of example, what is the, I will give the example. The help of examples we can easily understand. If you look at the companies, Reliance company, Tata, Infosys, Airtel, and SBI companies. So whatever the total number of shares which is available with the Reliance is 10,000, 2,000, Infosys, Airtel, and number of free float shares which is there for the number of shares they will be given, and price of the share is rupees 20, 30, 40, 50. So total market capitalization rupees is your 20,000, 60,000, and free float will be your 16. So in the examples, Reliance is having a 10,000 shares outstanding in its balance sheets, and out of them, 800 shares are generally public shares, and the balance 200 shares are held up by the Ambani's families. So similarly, 1,000 shares of SEBI are held up with the government, and the balance are the balance are with the public dominance. And when we calculate the total as well as the free float of market capitalizations, we'll use latter for the Sensex computations. Now we'll understand the whatever the things which is there for this Sensex. So if you look at this new capital market plus divided by the old capital market into 100 is going to give what is the thing. So the Sensex is going to move upward to 560 from 100. So it should be noted that practically this process is done on real time basis, and the reverse Sensex is computed for each and every 10 seconds. So modified capitalizations weighted means it is going to reduce the effect of the large stock market in the index, which would otherwise dominate the value of the index. So we can consider it has one of the largest group of the stock market, that is with the help of Nasdaq. And prices means whenever consider the price of the particular things, and equal means we are being distributing and we are be diversifying equally to the weights of the things. That will be deal with the things. So whenever we are going to compute the market price, so with the help of the example, I'll explain. So here we are having equity shares of the company X is having 100, which is having parallel of 10, and equity shares of the company Y and company Z, and the market price of this X, Y, Z scripts are your 20, 30, and 40, and market capitalizations, which is called as a number of shares multiplying with the price of the shares. So we'll be having 2,000, 6,000, and 10,000 value market capitalization value for the X and Y. So whenever we are going to aggregate that market capitalizations, that is with the help of 18,000. So index at price is 100 rupees, market price is n plus 1. Y share price is 25, 40, and 50, and market capitalizations, if you do with market cap, that is 100 into 25, 200 into 40, and 250 into 50. We got the market capitalizations. When we are getting aggregate is 23,000. So here index price is n plus 1, which is will give in 20,000 into 2,300 into 100 divided by 18,000, that will be giving your 127.7. So these weights may be trading volume of a particular scripts. When these index are going to use the trading volumes as a weights, it shows the depth of the market in terms of the trading volumes as well as conditions. So this is all about your weights which are been there computing in the stock market. What are the factors which is going to affect these Sensex means? First factor is your economic factor. Second was your the stable may I know who is this BRAOU Hyderabad? I think you are the host, sir. I don't know. But I'm continuously continuing the class. Not even a single participant is there, but still you are saying to continue the class. So economic growth, stable government. What are the stable government policies? Government policies, growth of the industries, corporate results, external demand, supplies, and the news. These are the factors, external factors, which is going to give an impact on the stock market. And whatever the things which have been there in the calculations of these stock markets, we are have different types of methods. That is different capitalizations, market capitalizations methods will be there. So if you look at the things of this stock market index will be considering as a barometer for the stock markets. They will be considering as a mirror for the stock market behavior. If the prices of that particular majority of which are been underlying securities are rises, then the index will be raised, and the vice versa. So whatever the stock prices index acts going to barometers which shows the overall conditions of the market. They are facilitate the investors in identifying the general pattern of the markets, and investors are going to take a stock market as a reference to decide about which stock to be going to invest. And the indexes which are been free float market capitalization methods, which is going to affect the things from the market. Sensex is going to compete on a free float market capitalizations, which is because of it is going to assume that the shares are going to held up by the promotions and which has been locked up by the day by day in intraday trading. So stock market is generally is going to be affected by the various internal and external factors. Market depends upon the internal factors like political condition of the country. Government policies, industrial growth, economic growth, and the corporate results are the example for this. And while the external factors like the world trade policies, IMSs, and the wars, etc., are going to be affect the Sensex. So the Sensex is not only considering the barometer of the market, but also it is going to give an indicator for the growth of the country, which is entirely depend upon the industrial development. With a view to provide a better representations of the increasing number of listed company, larger market capitalizations, and the new industry sectors, BSE will be launched. And here we can consider this whatever the indexes which have been launched, they are going to consider as the indicators, and it is also referred as a certain number of indexes which have been offered in the market. We'll move on to the security evaluation. Security evaluations means whenever we want to evaluate the security evaluations, we are been evaluating with the help of two terms, two main important components of the investment, that is with the help of your risk and return. So whenever we are going to categorize the risk and return, first we have to know the types of risk. General categorizations, the types of risk generally categorized into systematic risk and unsystematic risk. So before that, first we learn what is the exact security evaluations. Means every investment involves uncertainties, which is going to make the future investment returns risk prone. So risk can be defined that the probability that there is going to expect return from the security which is not yet been materialized. So these uncertainties could be due to the political, economical, and industrial factors, and it is always uncertainty of the incomes for the loss or sometimes for the both. So higher the risk is taken, the higher will be the returns, but proper management of risk involves a higher choice of the investment whose risk are being compensating. So here we'll consider these risks. So definitely the systematic risk and the systematic are the two categorizations of the risk. So what is a systematic risk? If at all any kinds of a fluctuations of the market is not going, if it's going to directly give an impact on the market, that is called as a systematical risk. So here the systematical risk market directly it is going to give an impact on the return on your investment, other that may be a credit, that may be your interest on the investments. All those things will be considering as a systematic risk. So what is the things which is included in the systematic risk? Interest rate risk, market risk, economic risk, inflation risk. These are all the categorizations of your systematic risk. Non-systematic risk, the total reasons which is not at all related to the overall market variability, that is called as a non-systematic risk. It is a unique for a particular security, and it is entirely associated with such factors such as business and financial risk as well as a liquidity risk. So all the securities which is having some non-systematic risk generally connected with some stocks which will be called as a systematic, and that is attributed to the board of directors, board macro factors, and which is going to affecting all the securities. So general categorizations of this risk is your systematic risk and unsystematic risk. So already I have said that under systematic risk, you are having different types of, that is economical condition, political condition, sociological condition. Indicates beta tamudu. So under the systematic risk, we are having three types of classification: systematic risk, and market risk, interest rate risk. Market risk is returns which is going to resulting in the fluctuations in the aggregate market, which is known as your market risk. So all the securities which are exposed under market risk, including the recession, structural changes in the economies, loss, whatever may be the things. So here the causes of these phenomena are we going to vary with the mainly due to the changes in the investors' attitudes towards the equity in general, as well as towards a certain types of the groups of the securities in a particular. So these variability in returns on most common stocks are the due to the basic swiping of the changes in the investor expectations. So whenever any kind of so this sometimes this market risk has also been concentrating on the investors who will be investing in intangible assets. That means these intangible events is also been related to the market psychological factors, and this is usually touched up by the reactions to the real invest. But whenever emotional instability of the investor acting as a collective leads, they will to the snowball of the overaction. So this initial decline in the market is going to cause a fear of loss to give the investors and kind of a fear which is going to inject the bills as well as the investors. So one the investor would notice that when the stock market surges up, most stocks post the higher price. So on the other hand, whenever the market falls sharply, most common stocks is going to drop. It is not that uncommon to find out the stock price falling from time to time, but while the company's earnings are raising or vice versa. The prices stock market may be fluctuating widely within the short, even through the earnings remains unchanged and relatively stable. So this is all about your market risk. Whenever we are going for the interest rate risk, the variability in the security returns resulting from changes in the level of interest rate risk, which is referred as the interest rate risk. Such changes may be affect the securities inversely. So the root cause for this interest rate is always lies on the fact that the rate of interest paid on the government securities rise and fall. The rate of return demanded on alternate investment vehicles such as the stock, bonds, and risk-free securities. The cost and money for more risk-prone issuers, private sectors will also change. So, investor normally regard as a government, which has been approximately called as a pure of the rate of interest at the cost of hiring. So, in India, interest rates are regulated by the RBI, which is manipulating a bank rate, repo rate, as well as the reverse repo rate. So, increase in the interest rate is which is always increasing on all top corporate companies. Purchasing power risk, a factors which is always affecting all the securities in purchasing the power risk, which is also known as inflation risk. This is possible that the purchasing power of the investor dollars will always declines with the uncertainty fluctuations. The real and the returns involves even if the nominal return is safe. So this risk is related to the interest rate since the interest rate generally rise as the inflation risk increases because lenders demands additional inflation is going to premiums. So raises prices on goods and services are normally associated with the what is referred to as inflation. Falling prices on goods and services are termed as deflation. Both inflation and deflation are covered in all encompassing term purchasing power. Generally, the purchasing power has come to be declined, identifies and with the inflations. So whenever we consider all these things, the annual changes in the consumer prices index are other measures which is purchasing power have the average steadily surrounding of it some particular period of it and particular percentage of it things. And systematic risk. So it is a unique and peculiar to of a firms or industries, the nature and the model of raising the finance and paying the back of the loans which is involving this unsystematic risk. The fluctuations and transactions which is directly which the market is not going to give any impact on the return of the investments, that is called as your unsystematic risk. Means the business risk, financial risk, liquidity risk, all these types of a risk is not going to give any kind of this type of a risk will be involving as a unsystematic risk. So the categories under these unsystematic risk are these things. So here, business risk or liquidity risk, financial risk or credit risk, and the operational risk. We call these are all the unsystematic risk. Business risk. So generally, this risk of is going to faces a unique problem which has been developing a global oil situations and the whatever things. So business risk is generally divided into categories, that is internal and external. Internal business risk is largely associated with the efficiency with which firm conducts its operation within the broader operating environmental imposed. Each firm has its own set of internal risk, and the degree at which it's successfully coping with them is reflected in operating efficiency. The large excess external business risk is resulting in firms also face on its own external risk, depending upon the specific operating environment factors which is must be deals. The external factors from the cost of money to the defense which cuts the hedging ratio for clear. And the sales of some industries is also going to sales. Political policies are the part of the external business risks where the government policies regarding the monetary and physical matters can affect the revenues. As a holder of the corporate securities, each and every equity share and debentures are going to expose the risk for of the poor status of these companies. Financial risk, which is the variability of the incomes in the equity capitals due to the debt capitals. Financial risk is a company associated with the capital structures of the company. So the capital structure of the company consisting of equity funds and borrowed funds. That capital, financial capital is associated. The presence of these interest commitments, fixed interest payments is debt due to debt, fixed dividends payments on the preferred. The amount of residual earning available for the common stock dividends will be more variable than that of a interest payments with required to borrow and not to borrow. A firm with no debt financing has financial risk. By engaging in debt financing, the firm changes the characteristics of these things. So how we are going to measuring the risk? Always we are going to measure the risk with the help of the standard deviation and probability distributions beta. These are the financial techniques, most and powerful financial techniques which have been used in finance: probability distributions, standard deviations, and beta. So, with the help of the examples, we can call it. So, the conditions for the economy, the recessions below average, average, above average, and boom situation. So, the probability for these recession has been given 0.10, excuse me, 0.20, 0.40, 0.20, 0.1. So always the probability should be is equal to 1, and the return on stock market, stock A, stock B is minus 18, 4, minus 4, 12, 24, 13, minus 10, 2, 8, 12, and 18. So whenever we want to evaluate the return on market, first we need to multiply these probabilities into the return of your securities. That is 0.1 into minus 18, 0.2 into minus 4, 0.4 into 12, 0.4 into 12, 0.1 into 30. So we'll get the return, that is 14, 2, 8, 12, 18. Next, 0.1 into for the stock B, 1 minus 10, 0.1 into for the stock B is 2, and we'll get the returns as your minus 1.4 and all those things. So whenever we'll go for these, thus always the risk will measure with the help of standard deviations. This is there with the probability. The formula will be the risk on this single securities summation PDX square under root. So probability, with the probability we have to divide, and we have to take the deviations also for calculating the things whenever we are having the risk and return. So risk and return trade-off will move. So risk and return, the expected rate of return and the variance of the standard deviations which have been provided by investors is information with the nature of the probability distribution, which is associated with the single assets. However, all these numbers are not only characterized of a risk and return of the particular assets, but also how does one asset has been a specific trade-off between the return and risk influences the other with a different characteristic of return and risk in the same portfolio. మెల్లగా. And what would be the influence of these relationships to the investor portfolio? The very good example is the covariance and relations which are related and generally issued. and generally they are being issued with the help of the measures which have the phenomena. The relation between two variables by the both the concepts are very much helpful for these evaluations of the risk and return trade-off. So there is a positive relation between the amount of risk and the amount of expected return, and it is a greater the risk, the larger will be the expected and larger chances of substantial is loss. One of the most difficult problem for the investor is to estimate the highest level of risk at the which is able to assume. All the financial decisions which is involved some sort of a risk rate and trade-off, the greater the risk, the greater will be the expected return. This is all about your risk rate and trade-off. If you look at the graph for the risk rate and trade-off, expected returns in the graph. So risk return functions, risk return trade-offs, and the risk-free rate of returns. The more the risk, the more will be the expected return. Less the risk, the less will be the expected return. Risk-free rate of returns is the rate of return commonly required for the risk-free securities, and it is commonly associated with the yield of government securities. And the functions is always depend upon the degree of risk and return. It is measured along with the horizontal axis and increases from left to right. The expected rate of return is measured by the vertical axis and the bottom axis. This is about your valuation of your risk and return, valuation of common stock. Will continue valuation of risk in the next class, ma. Hello, sir. Hello, BRAOU Hyderabad, sir. Can you please respond? Now, shall I close the class, sir? It's 11:30. Still, no one has joined, but I have taken the class. Hello, sir. Can you please respond? Hello, sir. Ah, sir, I'm ending the class, sir. It's 11:30. Without a student, I have continued the class. Thank you.